गढ़बो नवा छत्तीसगढ़।
The last few days, the conversations have been around how would global investors or global advisors view India in light of all that's happened. First, the cross-border tensions last week, which have all abated, and now the upcoming elections, and the fact that the Indian markets have seemed to have finally found their mojo. But to talk about all of this, somebody who tracks India very, very closely, well renowned for having his views on India, Mark Matthews of Bank Julius Baer, with us from Bangkok. Mark, so good having you. Thanks so much for taking the time out. Has your view changed a lot in the last 10 odd sessions? Because I see a lot of people in India having very different views 10 days ago when the India-Pakistan tensions were at their peak to now when they seem to have abated a bit.
I can't say my views have changed. I'm still worried about the non-bank financial companies more than anything else, because I've seen in other countries that when non-bank lenders have done as much lending as India has over the last 3 or 4 years, inevitably it's not just one, and there's a lot more bad debt that has to be accounted for. So that is the biggest thing holding me back from taking India away from our current rating, which is an underweight. As for the politics, I was surprised that the whole world didn't sell off a lot more when the trouble erupted between India and Pakistan. But thankfully, cool heads prevailed on both sides, and we haven't seen an escalation. And some people say that it's because both are nuclear powers, and with great power comes great responsibility. And so perhaps both sides know that it's just not something that should be escalated.
Interesting. So you, Mark Matthews, you are saying that for you, the bigger worry on India is the performance of the NBFCs and not the volatility that could come in as a result of the upcoming national elections.
Absolutely. I mean, the elections are important. A lot of people say they're not, and you can see plenty of research that shows that the best times to be invested in India were actually during Congress governments. In fact, I think there's a similar study that you can find with the Democrats in the U.S., who are purportedly less pro-business than the Republicans. But anyway, yes, I do think that the problem is the credit system, and I don't see a big pickup in lending, certainly not from the non-bank financial companies and not even from the banks themselves. And without more lending, I don't really see the investment cycle picking up. And ultimately, India has always functioned on two engines, the investment side and the consumer side. So the consumer side is fine, but the investment side is still sorely lacking, and I don't see that changing.
Okay, I will come back to this point. I would want to scratch your brain a little bit on that. But first, India on a relative basis to the other comparable economies in the, or the markets in the region. Let me actually correct myself, markets in the region as well. You mentioned that you have an underweight rating on India, and we'll get to those reasons too. But compare it to the rest of the pack. Would you believe that for reasons that you cited, or some of the others that people that you advise to would be talking about as well, flows over the course of the year would be stronger in other markets? I mean, the last 10 days, FI flows into India have been strong, but by and large, FIs have given India a bit of a miss.
Well, I guess if we're looking at the foreign investors, there's two main kinds. There's the ones who manage global money and the ones who manage emerging market money. Actually, I should say there's three kinds, because there's also passive investing through ETFs. Now, the passive investing, there I do think you're going to see positive inflows, because there is a general interest in emerging markets, and that's picking up, and for pretty good reason, actually. However, the relative managers they're in emerging markets, and they have to choose which ones they like. I don't think India is going to attract them much. First, there's the politics. Second, it's the only large emerging market that is trading at a premium to its 10-year average price-earnings ratio, and I suspect that it's even more expensive than people realize, because I think that the consensus earnings forecasts for this year are too high. And then I guess there's the, what did I say, the global money, the emerging markets money. So the global money, there you could see more inflows too, I think, if they're more inclined to own emerging markets. But maybe I'd just throw in one last observation on India on a relative basis, which is that the index provider whose indices are the most tracked when it comes to emerging markets is MSCI. And you may know that MSCI last Friday said they will be increasing the factor inclusion on mainland Chinese shares from 3% now to 20% in November of next year. And that means that just to achieve benchmarking purposes, money will need to reallocate to China. And therefore, some of it could come out of other countries in the emerging market space, including India.
For all of these factors, Mark, and I know you usually have been fairly sanguine about the prospects of India. When you tell me that you're worried about India or underweight on India, it gets me thinking. Would you believe, one, that there is a catastrophe, or maybe not a catastrophe, that's too strong a term, but maybe an issue within the NBFC space that will come up in the near future, which could bring about lending within the bank NBFCs and therefore maybe lending to consumers to a bit of a halt? I don't know if you've got such strong views or such depth views or no, but a view there. And two, would you reckon that because of the earnings downtick that could come about, we could see a correction in the valuations and the levels in India, even if the electoral outcome is what the larger markets seem to be wanting?
You know, rather than repeat what you just said, let me just say I agree with all of it. I think that there is a major risk of a significant NPA problem erupting in the non-bank companies. I think that there is a major risk that the Indian earnings will have to be revised down, and I think there's now political risk as well as we approach the general election. So I'm sorry, but it just doesn't sound that good right now. I want to also say something that I personally own Indian shares, and I will always keep them, and I do tell people that for the long term it is a great market to be invested in, if for no other reason than over the next 80 years, the population of India is going to go from 1.4 to 1.7 billion people, and the working age population won't peak until around 2040. So it is a good long-term story, but just right now, at this point in time, not the first place I would be putting new money.
Let me not preempt what your next answer could be so that you don't have to repeat me. Do you believe the index could correct?
Yes, I do. I think the whole world actually should correct right now. The S&P went up about 12% in the first 2 months of the year, and if you annualize that, it's 100, and I just don't think it's going to happen. So I think the whole world needs to reset, and I think you could easily reset a good 5%. And India is it's linked to the rest of the world, isn't it? The market is fully open to foreign investors. They have a lot of money there. So if people de-risk, they will also de-risk in India.
Okay, my final question to you, Mark. Everybody's spoken about, we've discussed all the key worries that are on the back of mind of people. The one thing that is a bit of a conundrum for me, and would want your thoughts here, oil. It's moved back to 65, 66 for the Brent. But if indeed the global growth is going to slow down, and OECD today or yesterday has said that those numbers are going to come off and come off quite dramatically, that would by nature mean that crude oil should come off, and that should maybe provide a bit of a solace to an oil importing nation like India. What are your thoughts here?
I think the OECD's forecasts are extremely late. I don't really see the world economy slowing down a lot. Of course, it will be less than last year, because last year you had the tax cuts in the U.S. which provided a phenomenal boost to that economy, it can't keep growing at that rate. It just can't. And so as you get a normalization there, it will take down global growth because the U.S. is by far the largest economy in the world. But I think China's going to hang in there. Europe will not. Europe is a drag for sure. But by and large, I mean, we're looking for world growth of about 3.5% this year. Sorry, 3.2, excuse me. 3.5 was last year. And 3.2 is a good number for world growth, so I wouldn't worry about it. However, in relation to oil, I think the most important thing to know is that next year is a election in the United States, and Republican voters tend to drive big gas-guzzling SUVs, and they tend to drive them long distances. And outside of Texas, they don't like a high oil price. So the number one thing that's going to keep oil from going up a lot is Donald Trump. And the clearest indicator of that to me is that they exempted 8 countries, including India, from the Iran oil embargo, and they're still buying oil from Venezuela, which is hardly their best friend. So I think that it's capped really for that reason more than any other.
And it would continue to stay that way, you reckon?
Well, for WTI, I think we could get up to 65, so there's maybe another $8 or $9 there. But because the Saudis are cutting production very, very aggressively now. Certainly, it's not going back to 100, that's for sure.
Okay. Well, for certain people, that should be music to the ears. For some oil bulls, maybe not so. Mark Matthews, one final thought, really. And amidst all the conversations that we've had, the one asset class that has really reaped rich dividends, I don't know if you have views there or no, but precious metals are just searing through the roof. What are your thoughts here, if you have any?
Generally constructive. There are 2 reasons why gold went up last year. The first was that the short positions reached an extreme level in the futures market, and there was just some mean reversion that had to occur there, and it's happened. So the shorts have come back. Basically, the market is still slightly short gold, but only very slightly. The more important reason is the de-dollarization of the Russian treasury because of the problems between Russia and the U.S., and they have been the big buyers of gold among the central banks. And the most interesting thing to me is that over the last 3 months, China has joined Russia in buying gold, and I think they will continue to. Not that they can shift all of their treasuries into gold. That's literally impossible, because you can put all the gold in the world under the Eiffel Tower, and the Chinese have a lot more treasuries than that. But I do think that as much as the trade relation with the U.S. and China, we'll see a good deal on March 27, thereabouts. After that, we all know that these superpowers are starting to collide, and I doubt the Chinese want to have all their eggs in the treasuries. And there's just no yield and not enough liquidity in the other sovereign bond markets. So I think gold will be supported basically by continued Russian buying and more Chinese buying.
Great. On that note, Mark Matthews, pleasure as always talking to you. Thank you so much for taking the time out, and have a good time in Bangkok.
Thank you. Thank you.
That's the view from Mark Matthews of Bank Julius Baer.